by someone came up to me before we started that it's the 100th anniversary of social insurance in the United States because workers' compensation programs started in this year, apparently in 2 states, Wisconsin, and what was the second state, John? New Jersey. New Jersey, that's right. Wisconsin and New Jersey. And so it's a fitting moment to reflect on NASI's development over the last 25 years, but also on the role of social insurance in our capitalist economy, and that's what I want to talk about today. Before I begin, I want to offer some thanks. It takes a lot of work to make even relatively small seminars go forth smoothly, and the staff here has been wonderful, both in making this happen and getting me here. And I also want to thank Lisa for that really kind introduction and for the leadership that she offers to NASI. I'm going to keep my introductions short because it's been impressed upon me that there should be time for questions, and I have a bad reputation. Ben came up to me beforehand. He said, I understand that this is Ben Vecht, who's organized this seminar. He said, I understand that you don't like to be timed. And I said, no, that's not the problem. The problem is that I don't listen to the person who's giving me the time cues. But he is under strict orders to stop me after 20 minutes, and I will not uphold that standard academic tradition of saying the same thing in 5 hours that it could have taken 5 minutes to express. Whenever I'm in this position, I'm reminded of a evaluation I received when I was a new assistant professor at Yale some years ago. And it began very promisingly. It said, Professor Hacker, if I had just 15 minutes to live, I'd want to spend it in your class. Because that way it would seem like an hour. Okay, so I'm going to speak for about 17, 18 more minutes, and I hope it seems really close to the actual time, and then I'm looking forward to a dialogue about what I say or what you would like to say. Okay, so the title of this seminar, of my talk, is Social Insurance in a Competitive Economy. And it's an odd title in the sense that if you listen to the current debate, I think you would choose a title that went something more like this: Social Insurance versus a competitive economy. It's fair to say that the idea that social insurance might be not just compatible with, but conducive to a dynamic capitalist economy is facing some serious skepticism in political discussions today. It's not, of course, that social insurance is unpopular. Far from it. If you look at the polling data, right, most Americans are overwhelmingly supportive of Social Security and Medicare and unemployment insurance and other core social insurance programs. My favorite poll on this is that a Wall Street Journal poll recently showed that even Tea Party supporters, by a more than 2-to-1 margin, declare that cuts to Social Security are, quote, unacceptable, which is a pretty strong position. So it's not that these ideas aren't popular, and it's not that we don't think they're relevant, right? I mean, after the worst economic downturn since the Great Depression, at a time when we seem to be beset by not just financial disasters, but a string of natural disasters, the idea that there's risk in the economy or in our society seems pretty hard to deny. No, it's instead, I think, there's 2 sorts of arguments about social insurance that really cast it in opposition to a strong competitive economy. The first is that social insurance is outmoded, that it's no longer consistent with a flexible, dynamic, innovative economy that allows people to take risks and seek opportunities. And the second view is that regardless of whether social insurance is outmoded or outdated, it's not affordable, right? We can't afford to maintain these programs. So I want to take on both those arguments. I'm going to give a lot more credence to the latter argument. I think there are very serious fiscal challenges posed by existing social insurance programs, though the solutions I'll talk about do not involve dismantling those core social insurance commitments. But I want to focus first on the first complaint, that social insurance is outdated, that it's not capable of supporting a flexible economy, and actually argue that this view isn't just wrong, that it's quite backwards. If you think about the founding moments of social insurance, the precedents for it, the ideas that were embodied in it, that actually the whole idea of social insurance was to support a capitalist economy that involved a large amount of predictable dislocation for people. Social insurance, in other words, was a way of providing soft edges on the hard realities of capitalism. And I also want to make a point that I think is often lost, and that is that there is no single model of capitalism. There are different models. There are different ways in which we can organize an economy on the basis of free exchange and free markets. What you might call high road capitalism, the capitalism that I think was embodied in many social insurance programs, said that capitalism had to be based on 3 pillars. It had to be based not just on property rights, not just on exchange, but these 3 kind of social aspects of a social contract. One of them was that the rewards of growth should be broadly distributed. That's not to say evenly distributed, but that everyone should feel as if they're benefiting from a capitalist economy. And the 2 other pillars were some basic level of economic opportunity, so free opportunity to move up the ladder, to seize on opportunities before you, and some level of security, that is protection against falling too far down the ladder. That's high road capitalism. Now, there is another model, if you will, that I think can equally be applied to the label capitalism, but is quite different. And I'll call it, to give it a negative cast, low road capitalism, right? And this model of capitalism says we should not worry about whether capitalism is delivering its growth, its rewards broadly, that we should not have any forms or guarantees of opportunity, which might include not even having basic public education, but at the least we should not be trying to invest too heavily in those kinds of human capital efforts. And third, and perhaps most relevant today, that we should do as little as possible to provide security, since security really interferes with the free play of the market. And I'm going to argue that low-growth capitalism isn't just less desirable from the standpoint of those who are facing its effects, or at least most of those facing its effects, since low-road capitalism often does deliver spectacular rewards to some, but it's also not actually conducive to a strong, vibrant economy where the creative energies of many, many citizens are harnessed to create long-term sustainable growth. And so my basic argument is that social insurance is quite compatible with the dynamic capitalist economy, but that we need to think about, as we go forward, what elements of social insurance are strong, which are weak, and how we make social insurance affordable. And so one thing I want to say about that is that often it's said, well, social insurance is different from private insurance, which is true. It's different in many ways. But one way in which it's different is that there is no competitive market to discipline policymakers, right? They can provide as much social insurance as they want. But that is just belied by the reality that if you look across countries, while there's a wide range of spending on social benefits, no country spends 75% of their economy, right? And there's a simple reason for that, right? First of all, if you got to the level where you're spending huge shares of your economy on social benefits, you would indeed hamper growth. But even more so, or even more important, social insurance has a powerful disciplining mechanism in the form of the reaction of voters, right? And in fact, the countries that have the most generous social insurance programs tend to actually have very broad-based tax systems that involve very visible direct costs for voters. The fact that citizens in countries with generous social insurance programs support those programs is a testament to how much they value them, because they see the costs. I think one of the real problems with the debate over social insurance today, right, is a debate almost always takes place with reference to only one side of the equation, right? Costs on one side and benefits on the other. To those who are saying, Paul Ryan is coming to get you, he's going to ruin your life, it's the benefits, right, that are the focus. They're taking away your benefits. To those who are saying, we can't afford Social Security, we have to change the program, privatize the program, it's right, the costs that are the focus, the tax-paying cost, and the cost to our society perhaps with negative effects on the economy overall. But what social insurance actually, when it's working well, and I think it often works well, does is equilibrate cost and benefits through 2 broad mechanisms. One is through democracy, and the other is through the market, right? When social insurance programs have very negative economic effects, people notice, and there's pushback, often from organized groups like business leaders. When social insurance leads to negative effects on voters' pocketbooks, they often notice, and they vote to change the contours of social insurance. So while I'm going to talk about how I think the basic social insurance package we have in the United States is extremely valuable, though needed updating in certain ways, I don't want to leave the impression that this is an agenda for doing nothing. It's rather an agenda for recognizing that there actually are very strong processes, really strong pressures that make social insurance evolve over time in ways that, if our democracy is working well, and if our markets are working well, is good for our economy and good for citizens. So the fundamental issue today, the concern that many Americans feel, is that the American dream is at risk. As I said, the three pillars of that dream, right, broadly shared growth, opportunity, and security, all look much weaker than they did 20 or 30 years ago, or even 2 or 3 years ago. Now, most of you know that we've had a very large increase in inequality in the United States. I'll leave you to read my book to get a sense of just how large the scope of that inequality is. I'll just give you one figure that I think really sums it up. If you look from 1979 to 2007 and take into account all government benefits and all federal taxes, about 40% of the growth of household income over that period accrued to the richest 1% of Americans. 40% of all income growth over that period went to the richest 1% of Americans. So for middle income Americans, this has been a period of very slow growth in income, even taking into account benefits and government tax changes. And this has occurred at the same time as these two other pillars, security and opportunity, have weakened as well. On opportunity, we now have tons of evidence from very careful cross-national studies suggesting that the United States, while having the highest level of inequality in the world, is actually pretty middling or at the bottom of the ranks in terms of intergenerational upward mobility. That is the ability of kids to rise to a level higher than their parents. We are very low, about 14th at last count, in getting kids through college. We were the world leader in college completion thanks to the GI Bill 30 years ago. Today we're about 14th in the world. But I'm going to focus on security, which I think has seen equally large changes. And the biggest change is that it used to be that we could expect that employers would provide a lot of the benefits that in other countries came through the government, health insurance and retirement benefits. But we know that those benefits have been seriously restructured and cut back in ways that have shifted a lot more risk and responsibility onto Americans' shoulders. And that leaves, of course, public programs of social insurance like Medicare and Social Security is basically the last line of defense for many workers buffeted by the winds of economic change. So we're in a situation now where the need for social insurance is as great as ever, in which some of the private substitutes for public social insurance have lost ground. And we're debating essentially how do we deal with the very serious challenges we face in our economy, at the same time as we know we have to figure out how to provide this social insurance for an affordable cost over the long term. So one thing that I think has to be recognized, and what I've emphasized up front, is that we should not see this as a cost, that social insurance is a cost we have to bear, as if we were just throwing dollars to individuals in the form of transfers. Rather, well-designed social insurance is also providing very critical ingredients for a competitive dynamic economy. And that's something that's been recognized and was recognized, what has been recognized for a long time and was recognized at the founding of Social Security back in the 1930s. In fact, if you look at the report that was put together by President Roosevelt's advisors, it was not entitled the committee. His committee was not entitled the Committee on Social Security. It was entitled the Committee on Economic Security. And the original name for the Social Security Act was actually the Economic Security Act. They very much believed that what they were doing was rescuing capitalism from some of the problems that they had witnessed in the Great Depression. So what were they building on? Well, they were building on precedents that actually came out of the business world. Things like the need for a secure money supply or bankruptcy protection for corporations and later for individuals. The idea of limited liability for corporations, right? These were all forms of insurance. And deposit insurance was inaugurated during the Great Depression, precisely because without it, there was these devastating runs on banks because people had no assurance that the basic investments and commitments that they'd made would be honored. Now, all these public and quasi-public institutions, right, which were aimed at business, not at individuals and not at workers, right, were building on the fact that government had a special role in providing risk management. And we've relearned that lesson very recently when we saw the systemic risks to the economy that were so great that only the government could step in, to great unpopularity, to try to prevent a full-scale collapse. And if you look across the world today, sure, you can find lots of cases of government overreaching, but you also see lots of economies that fail simply because they lack kind of basic forms of risk protection and insurance. Well-functioning credit markets don't emerge, entrepreneurs don't flourish when there aren't some basic protections against losing everything you have. And that's the same logic that lies behind social insurance. We know that today family economic security is under grave strain. We know that this imposes huge costs on individuals, and not just economic costs, huge psychological costs. Read some of these articles about the 99ers and what they're going through. We could lose a generation of workers based on what's happening in the labor market today. And all of us understand why this is, right? It's pretty simple. My son was young, he's 7 now, I used to sort of compare two things that I could do. One would be I'd give him a new toy. He's like, thanks, Dad. Then I try to take away a toy he's happily playing with. Trust me, the response is very different. This is called loss aversion, and it's a fundamental feature of our psyche. That when we are secure, when we have something, when we enjoy a job, when we have a basic standard of living, when our health is safe, losing that is enormously jarring, both financially and psychologically. So there are costs, psychological and economic costs, when we do not protect people against the most severe downside risks. And I just want to mention that those costs go beyond the ones I've already discussed. We harm individual growth and opportunity in our economy overall when we don't give people the resources they need to get back on their feet. We impose cost on our economy when we tie benefits so closely to work that there's job lock and inflexibility. And we know, to get this at the most kind of meta level, we know that there are big investments that people will be very reluctant to take without some protections against downside risks. There's ample evidence, for example, that countries that rely heavily on specific skills, investments where if you lose your job or you have to shift out of an industry, right, your skills are no longer going to be easily deployed in a new area, that countries with specific skills also have pretty substantial protections against unemployment loss. And that protection cannot be at a job, because if you lose your job, right, that's not where you're going to get help, right? They have to be economy-wide, right? So the idea that if people are going to invest in risky assets, if they're going to invest in human capital, if they're going to invest in skills specific to a job, that they need to have some insurance, that idea is not radical. It's not even liberal, unless by liberal you mean Adam Smith liberal economics. It's basic Econ 101, right? It's a basic idea that there needs to be some protection of downside risk if you want people to take large upside risks, given how loss averse all of us are. So the real question is not whether social insurance is can be consistent with a dynamic capitalist economy. The real question is, how can we reconcile the positive effects of social insurance that I've just discussed with some real risks that social insurance could cause if not well managed, right? And those are ones that policymakers of both persuasions know about, of both sides of the ideological spectrum know about, but would often get lost in these polarized debates. And so let me just talk about what I see to be the biggest of those. And that is, of course, the long-run fiscal impacts, right, of social insurance programs that are not properly managed or run in affordable ways. Now, I want to be very clear here. The biggest threat we face in social insurance today is runaway healthcare costs. It's simple to point that out, but it often gets missed on people. You could take everything out. In fact, Henry Aaron a few years ago had a chart that he was presenting at the National Academy of Social Insurance meeting where he had the Congressional Budget Office estimates, and he showed one set of results where you excluded Medicare, Medicaid, and its associated revenues, and there was no long-term deficit. Now, of course, this is before the downturn. We've done a few more unfunded wars since he probably put that chart together. But basically, the long-term picture without Medicare, Medicaid, and associated revenues is pretty darn rosy, right? We could fix Social Security very quickly if you look at what the long-term forecasts are. And in fact, NASI just released a report that showed how that could be done. Then you put in Medicare and Medicaid, and all of a sudden you have a sea of red ink, right? So this is the central reality. And it's easy for people like me who support Medicare to say this and say, hey, who support social insurance and Social Security in particular, to say this and say, look, you know, this is really healthcare. We have a healthcare problem, and not an entitlement problem, or even more specifically, right? We have a healthcare cost problem in Medicare and Medicaid, and not a problem not a healthcare cost problem in our system as a whole, and not a problem with Medicare and Medicaid per se. But that's easy to say, but the actual implication of that is that we need to figure out how to fund these rapidly rising healthcare spending. And there's only two ways to do it and preserve the commitments made in the past. One is, right, to figure out how to get more revenues in, which we'll have to do. For those who don't know, we are now collecting federal taxes at about 1950s levels. That is not a sustainable way to run a 21st century government. And I think that on the 10th anniversary of the tax cuts of 2001, it's worth considering whether or not we really think that continuing very large tax cuts for the most affluent of Americans is the best use of our scarce budgetary dollars at a time when inequality has grown dramatically and we're facing needs in these programs. I'll let you decide that question yourself. Okay. On the spending side, however, the answer is very simple. We have to figure out how to bring down the rate of increase of healthcare costs. We're not going to get it down to the point where it grows at the rate of the economy. If you look across rich democracies, the norm is about 0.5% in excess of the growth of GDP. That is, healthcare costs are growing on a per capita basis about 0.5% faster than the economy is growing. And if you get to that level of growth, things look a lot better. Then modest revenue increases or cuts in other areas can sustain these long-term commitments. Now, the bottom line, though, is the big question is how you do that, right? And I just want to put on the table that the current way in which we're discussing it, right, focuses entirely on the question of how can we get as little of the cost of healthcare, how can we keep as little of the cost of healthcare on the government budgets, right? Whatever you think of the Ryan Plan for Medicare, what it does is essentially shift a lot of the cost off of government budgets onto Medicare beneficiaries. But if the question is how do we sustain the commitments in these programs with modest adjustments, without shifting excessive amounts of costs onto beneficiaries, then we have to really have a difficult conversation about how you bring down healthcare costs system-wide. I'm definitely not going to begin that conversation when Ben is flashing a 0-minute sign at me, but to me, that's exactly where the conversation should be centered. But notice what I haven't said, right? I mean, I haven't said that the question of how we make social insurance compatible with a dynamic capitalist economy. It is. The question is how do we update the social contract so that it deals effectively with existing risks and deals with some of the new risks, like the need to balance work and family that were not well incorporated into the original social insurance vision. And I just want to end with a final point about why this is so important. I mentioned the equilibrating qualities of democracy and the market. I don't want to suggest that always that equilibration occurs in such a nice, smooth way. Now, lately people have been talking about one possible way in which a very sudden correction could occur. Oh my God, the bond markets will decide that we are living too far beyond our means, there'll be a run on the dollar, the economy will crash, the world will come to an end. So let me just, as long as we're throwing out scare scenarios, let me tell you what keeps me up at night. And it is not that scenario. Instead, it's that there will be a real backlash against the flexible dynamic economy that I do think is one of America's great strengths. Because if Americans do not feel as if there are some basic protections for them, I think they could also be very opposed to some of the kinds of reforms that we need in labor markets or in other aspects of our economy that are necessary to prosper in a global economy. If you go back to the original founding moments of social insurance, it was often actually seen as a way to hold off more radical criticisms of existing arrangements. So I'm not predicting a revolution. This is going to get out on YouTube tomorrow that, Jacob Hacker says workers are revolting. But I do think that the strains that we see now are leading to a very volatile political climate in which a lot of people are wondering whether or not the political system works at all to uphold the core elements of the American dream. And the American dream is about more than social insurance. And it's about more than a dynamic capitalist economy. It's about the idea that people can reach for their hopes and their dreams with confidence, without fear. And that is what I believe social insurance can help provide. And that's what I hope it will help provide in the coming century. Thank you.
Jacob, you have dutifully left some minutes for
Okay.
us to share with you.
Well, that was thanks to Ben's third or
There
fourth
are,
time he raised the 0-minute card.
So this is for you. I can't imagine a more fun person to dialogue about the biggest issue. Is it outmoded? Is it affordable? Could it be affordable? So please, we have mics in the bit if you want to signal a question or a reaction to Jacob. Please come forward. Oh,
We can hand one around too. Someone over here would like to ask a question, I believe.
Mr. Hacker, briefly, you mentioned the increasing costs in healthcare coverage across the system, and I think it's safe to say we're in a situation where the quality of care is increasing at a rate that we've never seen. And do you see this at some point plateauing off and becoming affordable again, or is this going to become a systemic increase in cost?
Well, the first thing to say is that actually the rate of increase in recent years has been a little lower than the historical norm. And so I actually don't see, and I don't see that being a permanent shift. It's tended to happen precisely when we've had major debates about reform. It won't be a permanent shift absent the Affordable Care Act actually having some impact on the rate of increase. But you mentioned quality increasing too, and I want to be clear. I do think that clearly American healthcare is much better than it was 10 or 20 or 30 years ago. But I don't think that the story of rising costs is just a story of increasing quality. And the comparative evidence, I think, is very helpful for us here, right? As I mentioned, other countries have had a much better success in restraining the rate of increase while covering all or most of their citizens. Their rate of increase has been, as I said, on average in OECD nations, excluding the US, about 0.5% of GDP, 0.5% in excess of the growth of GDP, whereas our rate has been about 2 percentage points in excess of GDP, a big gap. All of the comparative health evidence we have suggests that increased rate of spending growth does not deliver a whole lot in terms of increased health quality or value. Now, there are some major areas of exception, and I don't want to overstate it, but in terms of basic health outcomes and longevity, in terms of measures of financial risk against the cost of healthcare, in terms of premature mortality, which seems like a nice measure. It's a bad measure, but a nice measure in the sense that it captures the extent to which people who would have otherwise died had their death prevented by the provision of effective and timely care before a certain age, say age 75. Those measures all tend to suggest the U.S. Underperforms relative to its high spending, and that makes sense when you consider that a big portion of the spending difference is higher administrative costs, more lucrative remuneration, particularly for specialists, and more intensive use of medical resources in ways that aren't always very well tuned to delivering better health. I want to take another question. I just want to say I sort of tantalized at the beginning by saying, well, if the Affordable Care Act does something about healthcare costs. So I want to be clear. I think that there are a lot of measures in it that could reduce the rate of increase of costs. But given the difficulties of implementing this law, and I've written about this in a piece in Democracy Journal lately called Healthcare 2.0 or Healthcare 2015. So if you're interested in the full view, you can read that. It's going to be a very hard law to put in place, and the cost control sides of it are really centered on Medicare. And I think Medicare could do much better, and it is reduced, but it is worth noting that Medicare's costs have grown more slowly than the private sectors. The real question is, do we have a mechanism for bringing down costs, bringing the kind of innovations that we're going to be pursuing in Medicare to bring down costs? Bob Berenson, who's here today, has been thinking a lot about this. The two ideas I like are, one, having some kind of public option, so basically within an exchange that's offering health insurance benefits, health insurance to people, that you have some kind of public plan that's utilizing some of the strategies that Medicare would be utilizing, and it's competing with private plans. Or the other idea I like is for those parts of the system that are operating as fee-for-service or fee-for-bundled service or fee-for-diagnosis, using some kind of all-payer rate-setting system so that there's greater universality of payment across payers and greater leverage on payers to keep down rate increases.
I you contrasted the trend rate between the rest of the developed world and the United States, and yet the rest of the developed world doesn't have the same healthcare system. So what is the common denominator, in your opinion, that the rest of the world shares that we don't have?
That's a great question. So I think there are two common elements, and I'm not the person who came up with this coinage. It actually was Joe White, who for a time was here in DC and wrote a book for Brookings actually called Competing Solutions on Comparative Evidence. And he came up with this term which I liked, which he called what other countries did the kind of international standard. And as he described it, it had two elements. One, you've got everyone in the same system. And that's more or less everyone. I mean, there's a few countries that let very high income people opt out, but that seems to not cause a lot of problems compared with having a system that leaves a lot of working middle income people out. And second of all, the other thing was effective countervailing power on providers. And that didn't always take the form of a single payer. In fact, sort of monopsonistic single payer arrangements are the exception, not the norm. And many countries have moved a bit away from them. But what they do have is a system in which whoever the insurers are, usually sort of nonprofit mutual social insurance funds, whatever the payers are, they are coordinated to a certain degree, and they have the imprimatur of the state in bargaining collectively with providers. That again is changing, and it'll be interesting to see what happens in European countries that have moved away from that model. But that basic idea, where you have everyone in the same system, so cost shifting is not very easy, and also all of the insurers as a kind of consolidated block bargaining with providers, so that form of cost shifting from insurer to insurer is also not very easy, seems to be most effective in reducing the rate of increase.
We've got time for one more. And if there isn't, Jacob, could you close for us connecting, you mentioned Roosevelt's original casting of the Social Security program as an economic security program. And you also, we noted at the beginning you've done a new index. Would you connect for us what you've been seeing on economic security currently with
Sure.
this broader issue of social insurance?
Well, not surprisingly, the most recent downturn is the highest level we've ever found on our economic security index, and I should tell you what the index measures. The index is basically a measure, it's a limited measure, but it's a unified one that we can do for a number of years, from 1985 until 2009. The measure, and if for anybody interested, this is all available at economicsecurityindex.org. So the index basically measures the share of Americans who experience a 25% or greater decline in their income from one year to the next. Now that may seem simple, but there's a couple twists. First, we add healthcare costs to people's income. For those who don't know, the Obama administration has been moving forward to add healthcare into the poverty line. The idea is that when you have a certain income, let's say that you have two families, they're each making $10,000 a year, but one spends nothing on healthcare and the other spends $5,000 on healthcare, they actually have very different incomes. So we make that adjustment. All of the out-of-pocket medical costs that you have are subtracted from your income. So the 25% change from one year to the next could be either because you have an income drop or because your medical spending spikes, or some combination of the two. The second adjustment we make is we say if you have a lot of wealth, enough wealth to basically self-finance that drop, then you shouldn't be counted as insecure. So in the early 1980s, the number is just over 10%. In the most recent downturn, it's close to 20%. So we've seen essentially a doubling of the share of Americans who are insecure. And this is, as I said, a fairly limited measure. There are so many other ways you could look at this problem. You could ask what proportion of people experience those kind of events over, say, a 10-year period, and the answer is it's more than half of households experience a drop of that share, of that magnitude over time. And our inspiration was this concept of economic security, which is so central to public discussion, but which economists and social scientists in general have not tried to operationalize or analyze. There is no measure at the federal level I'm aware of economic security. We have measures of income, measures of poverty, of course. We have measures of unemployment, which is one of the core sources of insecurity. But we don't have a measure, basically, of the dynamic circumstances of people, how much their income or something else, their wealth, say, changes from year to year. And that's really what people are often concerned about. It's not, am I rich or am I poor? That matters. But it's also, how secure am I in my current status? And to go back to Roosevelt, Roosevelt understood what I was saying about the business innovations that led to social insurance. Not only did he stack the Committee on Economic Security with insurance executives, which leading a whole generation of historians to claim that he was some kind of toady. These are the sort of new left historians that have thankfully ceased screaming in the last 30 years or so. But also he talked explicitly about this. He once said, we once had a rich man's security and a poor man's security. But he said national security is not a half or half matter. It's all or none. And I like that phrase. I mean, I think that's what social insurance is about. Whatever you think of individual programs or their prospects, there's something so valuable in that basic idea that we're in this together, right? That we share in these unpredictable and devastating misfortunes that could hit any of us. And to the extent that people understand social insurance as that, and these numbers that I was telling you before that suggest such high support for these programs indicates to me that people do understand that to a significant degree. Social insurance expresses something very powerful about us as a nation, right? It expresses our sense of shared fate. And today, our fates often seem joined more in fear than in hope, but I hope that as we go forward, that we'll see social insurance is not just about protecting people when they're down, but making sure that they have the security necessary to look to the future and look up. So thank you.
Wow.